just did a video on Carvana. And gee, I wish I was following this stock closer. It went up 20x in a little over a year. I mean, it did start. It was real hot in the beginning. It was IPO'd at. Oh, I gotta go back further. So IPO'd around $10 in 2017, and then it got really $350 at its peak. This is mid 2021. Lots of stocks after COVID just shot way up. And this came down as expected, as most stocks do. And it looked like it was going to go bankrupt because it got below $4. So it was like less than half its IPO price. But even if you got it at $10, I mean, you had a long time frame to pick it up. It traded below $10 October 2022 to May 2023. So about 7 months, it traded below $10. So as long as you bought it and held, now it's up to 85. So it's up 1,000% in the past 12 months. And I mean, I guess it's so obvious after the fact, but geez, I wish I would have followed this closer. I didn't realize the huge run-up. I guess people were scared about investing in a company like this, but it's not a bad business model. They auction used cars or just sell used cars to people, which is an industry that's been around a long time. You're probably familiar with that big tower, the glass tower with cars in it. That's kind of their signature. So let me know in the comments if you want me to do a DCF. I can do one live. So what is this? So Airbnb. Wait, did I change this? So I'm working on Airbnb right now. I'm going to do a video tomorrow on that company. Pretty good numbers, pretty good financials. I mean, it makes sense. It's a great business model. If people want to make extra money by renting out their home, they can rent out a room in their home, or they can rent out their entire home. Or some people buy property and just rent it out on Airbnb. They don't even live there. So revenue is up $6 billion in 2021, $8 billion in 2022, $10 billion in 2023. Revenue is improving, but just as good as revenue, if not better, is profit. They went from a loss of 300 million to a gain of 2 billion to a gain of 2.1 billion. So not much improvement in terms of net profit from 2022 to 2023. Let's just look at that. Let's look at their margins. Is there any moat on Airbnb? I guess they have, well, they're number one in this space. So they have a strong brand, I guess you can say. I mean, in terms of moat, I guess not, but they have a really strong brand name. It's literally like a term you use. I'm going to just Airbnb it. Like everybody knows what it means. But you don't need a moat to make a lot of money. You just need to be profitable. Let's see, 5992. Let's see their margins. 5992, 8399, 9917. So their income, operating income, 429, 1802, 1518. Net income, so revenue, operating income, net income. It's good to look at margins because that's how you truly know, is it worth 106 billion? Well, let's find out. Operating margin, net margin, I mean, it is a big market cap, I'll give you that. So their margins are getting squeezed. They had 21% operating margin in 2022. It's down to 15%. Net profit margin is also down, went from 24 to 21. So why are their margins coming down? I mean, expenses are getting higher. That's obviously the reason, but what expenses are getting higher? And I hate when it goes from left to right, because most companies would have 2023 in this column, 2022 in this column, and 2021 in this column. They kind of do it backwards, which more important than net profit margin is operating cash flow margin. Operating cash flow. Let's see. So their operating earnings was 2.3 billion. Come on. 2313. 2022 3430, and then 3884. I mean, they sure generate a lot of cash flow. About 40% of their revenue is converted to operating cash flow. That's really good. They do have a lot of, no, they don't have any CapEx, which is great. They're kind of like the Uber of home rentals. I'll show you their price multiples compared to the industry, because that's how you kind of you can compare the companies together, because you can't say, oh, Airbnb has 100 billion market cap, so you can't compare their revenue to a company with like 1 billion market cap. It's just not a fair fight. But that's why you look at price multiples. They are trading at 10 times revenue, which is a bit steep. It's actually the worst on this list. So they generate the least revenue on this list relative to their market cap. But revenue is just one thing. Profits, cash flow, that's the most important thing. And high revenue doesn't mean you have more cash. So price to free cash flow is actually the median in the industry. Booking Holdings has a better price to free cash flow. But both of them, actually Airbnb is trading at 22 times earnings, which is not too bad, especially for a growth play. They're growing their revenue 22%, which is the highest in the industry. So I'd say it's worth pretty close to where they're trading at based on their numbers. really high margins. They low debt, 0.3 debt to equity ratio. I mean, you might have missed the run up, but I don't think it's too overvalued. I think it's valued actually at the point, at the right price. I don't think it's a buy or a sell. I think it's kind of like a hold. But over time, these kind of stocks go up. So its highest point was, let's see, IPO December 2020. So 2 months after IPO was its highest point ever, 212. It came down to 150, 130. Then it came back up to over 200. That was at the end of 2021. It never got up to 200 again. It did come down quite a bit, 85. It's just hard to know when the bottom is. I'm sure if you wanted to get in when it was trading above 150, you probably thought, okay, I'll wait a little bit. Then when it gets below 100, it's just like people just don't pull the trigger, and you never know the bottom. So even if you got in at 100, you're still up 27% today. You didn't have to get the very bottom. But if we want to, so the RSI is 50, so that's kind of in between. So that's kind of like my thesis. I don't think it's a buy or a sell based on the price. For a long-term play, I think it's fine. Short-term, I wouldn't say it's a screaming buy. Let's look at the candlestick chart. I pay for FinViz, but I think Simply Wall Street's easier to look at. Let's see. Yeah, it had a real yeah, it's kind of on a tear lately. I guess like the whole market is, right? It's probably trading at its 52-week high. Yeah, it's at its 52-week high today. It's hard to get an entry point, especially with this huge bull market. I mean, maybe you could have justified right here. This gap down would have been a good entry point. That was 130, so you would be up a little bit, like 7-8% from that point. There's a big sell-off. That must have been during earnings. Did you see Costco? Costco, they missed on revenue. They beat earnings, yet they still fell. Costco earnings. So what we're in March. So that was at February earnings. Yeah, they beat earnings 2%. They missed on revenue by 1%. This is the kind of stock that has to go up over time. With inflation, food prices always, prices are everything goes up. And food is, we can't live without food, right? And Costco is one of the best companies. They're probably number one in the big box kind of stores. You have like Sam's Club, and there's others, but I think they do it the best. They have the best margins, the best prices. I've been saying ever since I had the channel, them and Meta are my two number one stocks. And I have Costco on my wife's account, and we're up about 115% on that. So that's good. Let's see. They paid that special dividend. Oh, yeah, that's what I'm looking for. Events and presentations. March second quarter. I mean, the only thing they didn't do well, I think they tried to get into China, and they lost a lot of money, I believe. Am I thinking about the right company? Yeah, I think they tried to get into China. Oh no, maybe I'm thinking of Uber. Wait, let me see. Costco, China location. 6. Look at your portfolio, you feel so smart. Like, oh, I'm so good at this investing thing. I'm making so much money. And then when market goes down, you're like, I'm such an idiot. I don't know anything. Why can't anything go up? Third largest global retailer. So Walmart is number 1. Is Amazon their online retailer? I don't think they mean online. I think they mean brick and mortar retailer, third largest. So Walmart is obviously number 1 because I think they're the largest retailer in the world. Brick and mortar. I think Amazon's has more revenue than Walmart, but so who's number 2 then? If global retailer, maybe they do mean. Maybe Amazon is included. So okay, largest retailers. Well, they say global, so let's Walmart. Okay, so they are including Walmart, Amazon, Costco. Oh, Kroger. I didn't think they were number 4. My grandma bought 10 Walmart stocks at the IPO price. Wow, brilliant. She must have like a few hundred shares. Walmart. I don't even know if these charts go back that far. So if she bought 10 Walmart, I could tell you how much. Well, look at all these stock splits. Okay. 2. Oh boy. 2, 2, 2, 2. Let's see. 2, 4, 6. 2, 4, 6, 8, 9. Equals 2 to the 9th power. So if you bought 1 share at IPO in 1975, you'd have if you just bought 1 share, you'd have 1,536 shares today. She spent a few $100s on it. A lot more than 10x. Walmart. So $60 a share. So if you bought one share, did I do that right? Yeah, I did that right. 2 to the 9th power times 3. So one share is $92,000. So if she spent $10 on one share, she'd have $92,000. So she had almost $1 million. Ask her that. If she really bought 10 shares, if I did my math right, she has $920,000 in Walmart stock. I did that right because 2 times 2 times 2 times 2. You get 2 to the 9th power times 3. Yeah, I think I did that right. So that's like 49 years ago, she would have bought that. I bought 10 Meta shares. They were called Facebook at IPO. Well, not 10, when I say 10, $10,000 of Meta at IPO. And I think that $10,000 is $120,000. Even more impressive, if she did buy it in 1975, more impressive than doing that is keeping it for 49 years. It's hard to do that. It's hard to look at an investment that's really, really significant, like hundreds of thousands of dollars, and not sell it, because it's really like if you own your home and you heard that, like, oh, my grandma bought our home for $10,000 and now it's worth $1 million. Like, even though, like, you could technically, you're living in a home, you're getting something out of it, and you could even take a home equity loan. But when you just see your portfolio, it's hard not to sell that, especially if you need money. She bought the stock in 1989. Okay, well, that's still pretty good. 89. So that's 8. So that's 24. It's $60, right? So she should have $14,400. Are we buying Walmart or Kmart? Well, Kmart, is that still a store, Kmart? Are they still in business? Kmart is now operated as Transformco, is an online retailer in the United States, operates 6 remaining Kmart stores. Do you guys remember Kmart? That's the thing. Like, how do you know, like, what to buy? Like, I could see a lot of people buying Kmart because all those people who have success stories, there's so many more people who have stories about losing a lot of money. But if you could somehow predict, like, these companies like IBM and sit on it for decades, but even, I think, more painful, like, could you imagine, like, buying, like, or maybe not you, like your grandfather buying, 10 shares of IBM, but that hasn't come down. That's still a pretty strong stock, but it has come down from its peak. Let's see where it is now. It's actually trading close to its all-time high. let's see, it's 200 back in 2013. Yeah, it's trading to its all-time high. But could you imagine buying like a stock, like $1,000 of a stock, and then after like 20 years you have $1 million, then 10 years later you have like $20,000 or something like that? That'd be so painful, seeing your portfolio go from like a huge number to a small number. That's why it's hard to sit on stocks and not sell it, because or like if you had $1,000 and then 10 years later, like if you bought in like 1990, you invested 1,000, and then in 2010, just to say it's $1 million. Then in 2020, it's down to 50K. Like that would be so painful. But if it ever did come back up again, I'm sure people would sell it if it ever hit like, I don't know, like 200,000. That hasn't happened to me too much. The worst was I bought this stock called Waiter, and I put like 90K. Come on, I put like 90K in it, and I don't know. I just got real lucky. After like 2 weeks, Morgan Stanley bought a lot of it, so it was up to like 130, and I didn't sell. And then I ended up selling like at 30K, I think, or 20 something K. So I ended up losing like 60K instead of making 30K. And I would have lost it all, or it would have been $1,000, I think, today, because it's called ASAP now, right? What a garbage company. I really thought I found something in them. I thought I found something like real positive. Look at how much, I mean, it's garbage. Okay, so I think it was around here. No, it wasn't July 2020. I think it was around here. Yeah, beginning of 2021. I think that was. So I bought around here, around 70, and then it shot up like literally like after like a week or two. An investment bank bought a bunch of shares, and I was up like 20%. And I wanted to hold it not too long, but I generally like to hold stocks for 1 year because of taxes. Because if you sell within a year, you have to pay the higher tax rate. But if you hold it for a year or more, you pay long-term capital gains, which is a lot lower. You could save a lot of money in taxes. And then it just, I would have been like at a few $100 if I'm still holding. But I ended up, I think, selling around here. I could tell you, because I sold it because Netflix was coming down, and I picked up Netflix. So I sold it in January 2022, because that's when I bought my Netflix. So I sold it right here when it was 12. Okay, it's hard to go back. Okay, so yeah, at 13 I sold it, and now it's, what is it? It's 9 cents. It's 9 cents now. because I keep doing reverse stock splits, so it's killing. Yeah, it's just the market is brutal sometimes. Yeah, it is. I think I noticed they were starting to become profitable. I think I noticed in one of these quarters. I don't think we can tell on this chart because I think it was in 2021. They were starting to lower their expenses and become profitable. So I thought they were gonna I thought it was gonna jump, but we all make bad investments. That was one of my regrets, but have you seen David Hunter's predictions? Basically, mega melt up that pushes all stocks up regardless of fundamentals. I got lucky on a small midstream company getting bought. I was holding money until that's something I'm trying to figure out, what's a good acquisition target? What company is likely to get acquired? Because generally, if you're holding a stock and it gets acquired, it usually goes up 50% overnight. And there was a company in the cannabis space that I thought was a good acquisition target, and they did get acquired. But so it's the Airbnb. Lots of cash flow. I mean, really, really strong in terms of cash flow. They're buying back lots of stock now. They bought back 1.5 billion last year, 2.3 billion this year. So Snap, I remember I bought Snap. What did I buy? I think I bought options on Snap. Stitch Fix. But that didn't work out. I wonder, that was a while ago. I think that was in 2015. I bought it couldn't have been 2015. So it must have been 2017, because it was definitely well before 2020. So if I would have kept it at $10, $15, I would have been flat today, unless I sold it up here, which I probably wouldn't have done. They look pretty bad. Snap. Lots of losses. They're losing a lot of money. They do have positive cash flow. That's interesting when you see a company with such big losses with positive cash flow, because a lot of these companies pay out a ton in stock-based compensation. I bet you that's why. Snap. I bet you they're paying a lot in stock-based compensation. Because they don't have that much cash, so they need to subsidize the salaries for their employees. So you see, this is a statement of cash flows. So you take net income, they had a net loss of 1.3 billion. And then you add back stock-based compensation, which is 1.3 billion. So they pay a ton in stock-based compensation. Usually a company a young company that's not profitable, they generally have to pay a lot because they can't afford to give someone a $500,000 salary. So they give them $200,000, and then they give them like $300,000 of stock. So it is dilutive, but they are generating positive cash flow. If you strip out that big, Mo is into cannabis. Yeah, Mo is Oracle might buy Snap, possibly. Well, yeah, Mo, a lot of these tobacco stocks, they just kind of trade sideways, or there's not much upward momentum because they pay such big dividends. Like, that's why a lot of these tech companies don't pay dividends, because they want to keep reinvesting in the company to grow it. They pay such a big dividend, there's just less money to grow. And it's hard to grow with these types of companies, because they have to be real sensitive about like over marketing, because people get upset when tobacco companies market a lot to try to get new customers. How about Lumen beat down one of the biggest fiber internet providers, refinancing debt as we speak? Lumen, they used to be good in 20, 30, 40 years ago, but their technology is so old and outdated. They're losing. Every year they lose like 10% of their customer base to the newer companies with better technology. So you can see like their revenue goes down every single year: 21 billion, 20 billion, 17 billion, 15 billion. They have lots of write-downs, so they probably have positive cash flow. They don't have positive cash flow in 2023. 2022, they were generating a lot of cash until 2023. So they're shedding business. They're just losing business. Granted, they have a huge base of customers, so it's taking them like a decade or longer to shed all those customers, but that's why they're able to still generate so many billions of revenue. But they are losing a lot of customers. Eventually, they're going to be out of business. Because I'll be right back. If you want to be a part of the live stream, you could click on this link and join me, and we could talk to everybody. If anybody wants to go to Omaha for the Berkshire Hathaway annual meeting, email me. I'm trying to coordinate a meetup. That'll be fun. Maybe 2. Let's do 3. Yeah. So what we saying? What with profit margin of 200%, 200% per pound of product, these cannabis stocks can't make money. They're run by sleazy people. Hey, Dr. Jones. CVS, that's a good one. CVS, that's a great brand. How's the stock? Is it getting beaten down? Yeah, it's well off its all-time highs. It's hard to find stocks that are trading below their all-time highs. God's skin forever. But I think look how much revenue, 357 billion. God, that's a lot of revenue, right? It's just the margins are so slim in these industries, but they're profitable. They do have profits and lots of cash flow every year, 10 billion plus. They must have really, really good price multiples. Look at that price of sales, 0.27. So they generate $4 for every dollar of market cap. Yeah, what is their debt? I've been telling people about CrowdStrike. I think CrowdStrike is a really good. I mean, it's been going up a lot, so you might have missed the run up, but CVS. Yeah, they probably have a ton of debt. Let's see, financial health. Well, it is lower than their equity. 60 billion of debt, 76 billion of equity. Let's see how much cash they have. So 11 billion of cash. So they are a bit high in debt. Not terrible. CVS, SEC. Let's see the Aetna. That was the big one, big acquisition, right? So how do you guys feel about funding acquisitions with debt? It's kind of like if you had a company, right? If you had a small business, say you had a little grocery discount store, and you were making a couple of $100,000 a year in profit. So you were happy, you were doing well, and you wanted to buy a grocery store in the next town over. Wouldn't it be better just to buy it with the cash flow that you generate and not take on so much debt? They get squashed by Medicare reimbursements. Yeah, that's something to look into. That's hard to figure out. Like, it gets a little confusing. Trying to understand companies' financials when they're tied to medical reimbursements. Like how do you connect the dots? But it's an important thing to know. Let's see. Current assets 68 billion. Current liability 79 billion. So current ratio below 1. So that's not good. But they have lots of cash coming in, so it's not terrible. 58 billion. So if you're concerned about a company with a lot of debt, something to look at is when does a debt mature? If the debt matured like within a year or two, that could be concerning. It's kind of like if you had a loan on your home and you had to pay off the loan next year, you might be in pretty bad shape. Let's see. So the 58 billion. So you can see when a debt matures. See, it's a really long. Look how much debt they have. So in 2024, about 3 billion of debt is due. 5 billion in 2028. So most of it is in the future. But rates are going up, right? So it's not. These companies, here's a debt schedule. These companies don't usually pay off the debt when it's due. They just refinance it with other debt. So hopefully the interest rates go down because you don't want to refinance it with more expensive debt. Teladoc brought company, then write off everything. So So yeah, 3 billion due this year, 4 billion. So they have time to pay down the debt, but you don't want to see companies constantly issuing so much debt to fund these acquisitions, because it just gets kind of out of hand, the debt. Yeah, you're saying CVS acquired teledoc companies and had to write them off, like the goodwill? Sheesh. So if you want to know how much money the company spent in acquisitions, how much they spent like above what the company's worth, that's goodwill. So goodwill, 91 billion. So that's probably the biggest asset. Yeah, that's like 25% of their assets is goodwill. So they do a lot of acquisitions. Let's see if and that I mean, it's hard to grow organically. When we can't all be like Apple, right? Apple is one of the best companies at growing organically, because I don't think they have any goodwill on their balance sheet. But so if you want to get into more neighborhoods, more cities, more countries, you have to really acquire other companies, because it could take 20, 30 years to build a brand in another country, and it's hard to do that, especially if you're not from that country. You're a US company. If you want to get into like China or Europe, acquisition is really the only way to do it. Hey Mike, what's up? And companies will have a lot of successful acquisitions and a lot of duds, like AT&T when they acquired Warner Brothers, and then a few years later sold them for like half the price they acquired them for. But these things happen. As long as historically you don't keep acquiring companies that are over, you pay too much for. Because it's kind of like you're investing. You can buy garbage stocks once in a while if you want to gamble, but like you can't just do that every time. You can't invest in all these crap stocks, because eventually you're going to run out of money. But once in a while, if you invest in a stock and lose 90%, 100% of your money, it's no big deal, as long as it's a small part of your portfolio. Just like when a company acquires another company, it's no big deal if they waste money on acquisition, as long as 2 other acquisitions turned out to be really good. Let's see what it's so kind of plain, right? Their investor presentation. So they're the 12th largest Fortune 500 company, 321 billion market cap. I thought it was higher, 321. I mean, I'm sure it's right, but I always thought they were like 400 or 500, but maybe not. 321. Look at that. Look how well they're doing. Unbelievable. Sales, 244 billion. 128 million square feet of space, of retail space. 316,000 employees. They employ a big city. That's like that's a decent sized city, 316,000 people. So US and Canada is their focus, but they're in a lot of countries. They have 6 in China. I thought they had problems going into China. Maybe I'm thinking of Costco success in China. To shop at a retail giant with. How did Costco succeed in China? I guess they did okay in China. Well, they only have 6 locations, so it's not that great. But and that's not a lot of locations. 874. Like there's like 40,000 McDonald's. So there's definitely a lot of opportunity to continue growing in the U.S. Of course, other countries too, but there's plenty of big cities I'm sure they're not in. 73 million households, 132 million card members. So that's an asset right there. That's why I think like Netflix it's such an asset to have so many people going to your service because they can advertise to a lot of people. Or they have a lot of data that companies want. A lot of data about, income levels, how much people spend. So that can be monetized. High renewal rate. Like I don't even think twice about renewing Costco. I save so much money by shopping there. And they do get a lot of membership fees. The $5 billion just in the membership fees. That's how valuable it is to be a member at Costco. People are willing to pay. We're paying nearly $5 billion just to be a member without even buying any food or anything. It's like that gym membership. A lot of people pay for a gym membership and never use the gym. But I don't think it's like that with Costco. I think most people are using it. No parking spots. Right, I know. It's hard to find a spot. Well, if you go on weekends, it's hard. If you go during the week, that's usually the best time to go. But most people are working. Sales up, not quite, maybe like 7% from 2022. Margins up a little bit, which is good because it's getting more expensive. Things are getting more expensive. So you would think margins might actually go down, but they've improved. But their margins are probably higher in 2021 because inflation kind of peaked in 2022. So about 2% of their revenue is memberships. The rest is like sales of food and whatever. SG&A is getting a little higher. That's 9% of their revenue. Operating income, that's up. Net income is also up. So EPS is up $1. So that's good. Really good improvement. So in the most recent quarter, their sales were $57 billion, up 6% from the same quarter in 2023. Operating income is up. Net income 19%. That's pretty big improvement. 19%. So their second quarter sales. Wait, why does it say millions? And this is percent, including the impact of gasoline prices. So I think this is same store sales. It's up most in Canada, 9%. What's ticket mean? Including the impact. Okay. So 10 billion of cash, lots of equipment, not much debt, only 7 billion of debt. When you have more cash than debt, you can consider yourself debt free. It was your option to use the cash for something else. maybe you're investing your cash in the stock market or whatever. Equity of 21 billion. 40 cent. Their first dividend was 40 cents in 2004. It's currently $4 annually. Their CAGR is 13%. They pay 1.8 billion of dividends. They buy back lots of stock. CapEx of 1 billion. Yeah, they have all the big companies. They sell all the best products at the lowest prices. Pretty good, pretty impressive. Okay, well, I just wanted to hop on. So I'll probably do Airbnb tomorrow. A video on them. I may do a live stream tomorrow. So until then, have a good night. Have a good weekend if I don't talk to you. And hopefully you'll be on tomorrow when I do a live stream. Talk to you tomorrow.